Good afternoon and welcome to the March 12th, 2025 edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I thank you so much for joining me for today's edition. As always, I want to tell you just a bit about the center, then issue a quick disclaimer, jump into some updates, and then we'll go into answering the specific questions that have been submitted by our community. So, about the Maryland Center for Collegiate Financial Wellness. We call it McFew, or the center, but it was founded in 2021 with a vision for all college and career school students in the state of Maryland, and that was that they should be able to achieve these 6 pillars of collegiate financial wellness. Those are being creditworthy, ready, resilient, empowered, successful, and thriving. So if that sounds like a vision you'd like to know more about, please do visit us online at MCCFW.org. And if you have been a part of this community for a while and you've benefited from the information, programs, or resources shared by the center, please do support. You can subscribe to our newsletter, or you can make a donation that's tax deductible at mccfw.org/support. Now, this particular program, Office Hours, I have to issue a disclaimer about the content presented during Office Hours videos. Office Hours is presented for informational purposes only. The information that's presented during the broadcast does not constitute personal, legal, or financial advice. We do our very best to give you the most accurate information possible, but you really need to, take the information that you get from trustworthy sources like the center, as well as information about your lenders, but your own preferences, circumstances, and including your income and the number of people you're responsible for. Take all of that into account before you make any decisions about how to strategize around your student loans. And if you've been keeping up with the news, there's a lot going on, especially recently. So that's a great place to segue into our update section. And I've got a few, so I want to make sure that I get to them all. So the first update that I wanted to give is that I know many of you have probably been paying attention to the news. Just in case you haven't, the Department of Education has experienced some massive layoffs, and I don't remember the exact number, but I think it might be near 1,000 people have been let go. We don't have a lot of details on that, but I know that we have a lot of colleagues that work within the Department of Education, especially the Office of Federal Student Aid. We also have colleagues at the Consumer Financial Protection Bureau, and they're experiencing similar happenings. So I just wanted to say to all of our colleagues at both of those agencies that we're definitely thinking of you, hoping for the best, and we're here to support, and we're watching to see how all of this pans out. But just know that we're rooting for you. Next, the natural question for student loan borrowers is, well, if the Department of Education, has my loans, or if I owe them money and it's going to shut down, then what's going to happen to my loans? And as of right now, we don't have any clear indication of what's going to happen to the loans, but we do know the student loans are not going away. So one thing you should not count on is that if the Department of Education goes away, then your student loans will automatically disappear as well. That's not the case. What we have heard a bit is that maybe student loans will be placed in another agency. But again, that was just, commentary. That wasn't any detailed strategy or any policy or any directives. That's just, murmurings that we've heard. So just know that your student loans are still there and your payments are still due. Next, I'd like to shift to local government, particularly the state of Maryland. We had an excellent time. That's Team McFew there on the screen. That's me on the left. That's Melanie Mason, our Director of Programs and Administration in the middle, and Tiffany Brown, who's one of our student loan strategy coaches. And this picture was taken at the Maryland House of Delegates on Monday evening. We had the pleasure of being recognized on the floor by the House of Delegates for all the work that the center has done to help college and career school students make more informed financial decisions, and also helping public servants access more than $21 million in debt relief, particularly through the Public Service Loan Forgiveness Program. So we had a great time in Annapolis on Monday evening, and also received an award presented by the Maryland State Department of Education, the Maryland Council on Economic Education, and the Cash Campaign of Maryland. So a very Maryland-centric evening. and they gave us the honor of being recognized as community champions. So I'm thankful to all three organizations, as well as the state of Maryland and the Financial Education and Capability Commission, and had a great time. And I'm just really appreciative of my team and proud of the work that we've been able to do. The last thing that I want to give you for an update is also from the state level, and that is that we have a few bills actually that we supported in this legislative session, which in Maryland runs from January to April, so it's not over for this year yet. But two of those bills, HB795 and HB920, which were introduced in the House of Delegates, have crossed over into the Senate now. So both of them had favorable reports from their respective committees, and they have made it out of the House chamber into the Senate, and hopefully we will see some positive action there. Just for a refresher, HB 795 is a public service loan forgiveness awareness and certification bill. This would just provide employers with more clear information created by the State Student Loan Ombudsman about PSLF, guidance for employers to help employees apply for PSLF, and also making sure that there's clarity around the amount of credit that our adjunct faculty colleagues can get when they're applying for public service loan forgiveness. And HB 920 is an institutional debt bill. This has to do with the reporting of information about debt that students owe directly to their institutions. So not student loans, but balances that students have on their accounts. And this is just a transparency bill, trying to get information from schools about those bills so that we can see if there are any trends, further policy initiatives that could be enacted to address those trends, or interventions that might be able to be created and implemented by organizations like the Maryland Center for Collegiate Financial Wellness. So thank you to Delegate Spiegel, who introduced both of these bills, as well as our partners at the Student Borrower Protection Center and the Cash Campaign of Maryland. All right. Now that we've got those updates out of the way, we can get into the questions that have come in from our community. So let's take a look at question number one. That question is, IDR and consolidations are down. What does that mean to me? All right, so IDR stands for income-driven repayment, and consolidation is pretty self-explanatory, but both of these are applications that were on studentaid.gov. So this question is about federal student loans, and currently both the applications for income-driven repayment and for loan consolidation are not available. And the person wants to know, what does this mean to me? So let's take a look at the answer. So all of this activity stems from Saving on a Valuable Education, which was an income-driven repayment plan that's actually an updated version of another income-driven repayment plan, but the updates were made by the Biden-Harris administration. There were several lawsuits filed to stop SAVE from being fully implemented, and those lawsuits finally landed successfully in the summer of 2024, just a few days before the second part of SAVE was supposed to be implemented. So a federal court issued an injunction that prevented that full implementation, and that injunction was recently expanded last month. And it's affecting parts of other income-driven repayment plans like pay-as-you-earn, income contingent repayment. Now, income-based repayment was the repayment plan that we thought would be left out of this, because income-based repayment, which is known as IBR, was actually created by Congress. So it didn't come from the same place as SAVE and some of the other income-driven repayment plans. So IBR was safe for a bit, but this injunction is broad. So the current administration decided to pull down the online applications for both income-driven repayment and consolidation, because the application to consolidate is actually, it actually has the income-driven repayment plan application inside of it. So there is no online access whatsoever to income-driven repayment plans. To answer your question, it just means that you would not be able to apply for an income-driven repayment plan or a consolidation loan if you go to studentaid.gov right now. And we've heard some mixed things about paper applications. I believe the paper applications were pulled off of studentaid.gov as well. But we have heard from some borrowers who are saying that their servicer has told them to submit a paper application. We don't know what the processing will be like on those applications, or if it will happen at all. Just know that for now, the online applications are down, and that leads us to believe that IDR applications and consolidation applications are not currently moving forward. All right, let's go to question number 2. It says, I have private loans. Do these changes made by ED impact me? So ED is the Department of Education, and this is a pretty easy question. So let's take a look at the answer. So changes that are made to federal student loans do not impact private loans. The lender options are specific to the lender. So when you hear all of these changes that are taking place in the world of federal student loans, just keep in mind that federal student loans are from the federal government and private loans are from private or alternative lenders. And each lender has their own set of rules. So the changes that are made to the federal student loans will not affect your private loans. Now, I do need to go back and revisit question number 1. Thank you, Melanie, for updating me. So it looks like the paper application for consolidations is online at studentaid.gov. So correction to that answer. The online applications are not available, but the paper applications are now accessible on studentaid.gov. So my apologies for that mistake. If you go to studentaid.gov, you should be able to get that application. All right, let's move on to question number 3. All right, this is a tax question. Do student loans have to be reported on taxes? Let's get some background first. Okay. I already filed my 2024 taxes, but I recently noticed that Mohela sent me an email on January 24th that I missed with a link to a 1098E. Do I have to refile because of this form? All right, let's take a look at the answer. What I'll say before we start to talk about the 1098E is that with student loans, if you report them, the potential is to lower your income. So that's not something that you should necessarily feel compelled to report. There wouldn't be a penalty for missing out on a deduction. But if you had a significant source of income and you didn't report it, then that definitely would compel you to refile so that you can make sure that you have paid all the taxes you're supposed to pay. So let's get back to the specific answer for this question. The 1090E is a form that reports the amount of student loan interest that you paid during the tax year. Now, some borrowers are able to deduct up to $2,500 worth of that paid student loan interest from their taxable income. And as I mentioned before, a deduction is something that can lower your taxable income. And if the deduction is significant enough, it could also reduce your tax liability. So if you are a borrower who is eligible for the student loan interest deduction, and you do the math or use some kind of software online to figure out if it would make a difference, if you find that that deduction creates a change that makes it worthwhile for you to file your taxes again, then you would submit what's called an amended tax return. And your amended tax return would include that previously unreported student loan interest that you paid during the previous tax year. All right, let's move to question number 4. That is access to new Mohela. We definitely need some details on this, but there have been a couple of things that are happening. We used to have everyone go to Mohela.com, but now that studentaid.gov is kind of more enrolled in the customer service aspect, the place that you need to go for your federal student loans is mohela.studentaid.gov. But there's also another branch of Mohela that handles private loans. So you've got mohela.com on one side, and then you've got mohela.studentaid.gov on the other side. And some people who were going to mohela.com before still have to get into the rhythm of going to mohela.studentaid.gov for their federal loans. So let's take a look at the background for this particular borrower's question. So it says, my loans were forgiven in 2024. Thank you, Lord. Congratulations, by the way. Mohela emailed me about a 1098E for tax reporting. There's a new site and I was able to register just fine. But when I tried to log in, the account keeps giving me an error. Do I have to access the new site for this document? So if you're able to log in, this screenshot shows you that the student loan interest statement is available and you should be able to access it online. Let's go to the answer because sometimes the access isn't quite as straightforward as this. So, one of our student loan strategy coaches is in the same situation, and you will need to contact Mohela about creating an account and getting your access. Please just be prepared to experience long hold times. And we've heard some people have experienced success by trying to call when Mohela opens. So go to their website, look at the customer service hours, try to call early, and just factor in the possibility of being on the phone for a long time. We have seen a lot of people who had their loans forgiven not be able to establish an account or reestablish an account on what people call new Mohela because they don't have loans anymore. And so just know that you're not alone in this, but you have to go straight to Mohela for the best chance at getting a resolution. All right, let's move on to question number 5. It's, can I file for bankruptcy and have my private and federal loans included? All right, let's talk about bankruptcy. Let's take a look at the answer for this question. So, bankruptcy is something that you can file for. Of course, it's difficult but not impossible to have your student loans discharged as a part of a bankruptcy. Those loans could be federal or private student loans. Now, bankruptcy is often considered like a last resort because it has far reaching consequences and a lot of impact on your credit, as well as the time and costs associated with filing. Now, at the center, bankruptcy is one thing that we do not get into. We're not attorneys. We focus more on student loan repayment strategies, and bankruptcy filings are not a part of our services. So with that being said, we recommend that you look for a reputable attorney and speak with them, and look for one who's experienced in bankruptcy. There are some out there that are experienced in student loans and bankruptcy. So look for some of them, and they should be able to explain the process and your chances for success. If you're experiencing difficulty paying your student loans, then of course the first place you want to call for federal loans would be your servicer. For private loans, it would be your lender. So try to exhaust all of the options that you have for flexibility there. But if bankruptcy is what you feel you need, just make sure you get solid advice about it before you go ahead and file. All right, let's take a look at the next question, question 6. That is, am I forgiven? Well, we're going to need to see some details to answer that question. So let's take a look at the background. I logged on to studentaid.gov to check the status of my PSLF application. I am months away from forgiveness, but I recently submitted my annual employment certification. And when I logged on, there was no information under my aid. What does this mean? And you can see in the screenshot, it says it appears we don't have aid information for you in our records. One variation of this that we've also seen is you do not have any loans or grants. And in both situations, it can be a little frightening because you know that you had loans and now all of a sudden you don't. So let's take a look at the answer for this specific borrower. So Team McPew, like I said, has seen this quite a bit recently on studentaid.gov. We're not sure if this is just a glitch or if there's maintenance being performed with the records or the website. But when you see something like this, this does not guarantee that you are forgiven. For people who have had their loans forgiven, they can typically still see their loan history. So when they go into studentaid.gov, initially it says, you don't have any loans. But when you go to view details, you can see the loans that you borrowed before. So if you're receiving forgiveness via PSLF, another thing that you should receive is a notification. We call it the congratulations letter. You should receive that letter. It will explain, how much debt you've had forgiven and the effective date of forgiveness and a list of all the loans. And your PSLF tracker should also be 100% green and show, the congratulations. So if this were PSLF, you would see multiple messages about the victory, referencing congratulations, your qualifying payment count being 120 or more. That will be confirmed in communications. It's not just something that you log in and you no longer have records. So this is a different issue, but we still wish you the best on the road to PSLF. All right, let's take a look at question number 7. That is, how do I tell which school is most affordable? All right, brace yourselves. This is going to be a long answer, but it's a very good question. So we wanted to be sure to walk you through this step by step. So let's get a little bit of background first. It says, I will be a freshman next year and have started receiving my offer letters. They all look to be fully paid, but I recently noticed that they include large Parent Plus loans. How do I tell which school I can afford? All right, let's get into this answer. When you're reviewing your offer letters, there are several factors for you to consider. One is the cost of attendance. The cost of attendance is an estimate that your school's financial aid office comes up with. It's an estimate of what it would cost for you to attend the school for one academic year. So the cost of attendance is something you can get from financial aid. The next thing you want to think about is the sources of funding that are offered in that letter. It could be scholarships, grants, work study. We want to consider all of that before we go with loans. And then you also can think about any funds that you may be able to contribute yourself or your family if you had college savings or personal savings. Now let's move on to the next part to see how this all fits together. Now, for determining the cost that will be billed from the institution, we recommend a few things. The cost of attendance, remember, is an estimate. So locate that cost of attendance, look for it in your offer letter. Sometimes you might not find it there. So if it's not stated in the offer letter, you can visit the school's financial aid office online or call them. The next thing you want to do is look at the direct costs. The direct costs are costs that are going to be billed to you directly from the school. These are costs that you really don't have that much control over. This is your tuition and fees, your room and board if you're planning to stay on campus. So those are the items that will be included in the bill. Now subtract your scholarships and grants from that total, and this will tell you the cost that remains to be covered. I want to give a quick mention of our February newsletter. We had a little post in there that was about offer letters, 5 facts about financial aid offer letters. And if you have not subscribed to our newsletter, we're going to drop the link in the comments so that you can connect with us. And it's only monthly. I promise we won't spam you, but it's monthly and just provides a lot of good information at the federal and state level about financial aid and student loans and financial wellness, of course. So back to this question, though. You really want to figure out what the gap is, how much free or gift aid you're receiving versus what the bill is going to be. And if you have a gap, then you've got to figure out how that gap is going to be covered. So on the next screen, we're actually going to show you an example of using the figures from the cost of attendance plus scholarships and grants that are included in an offer letter to arrive at that gap. So for this example of determining what costs you could be directly responsible for, we went to Towson University. Shout out to the Tigers there. All right, so we're going to start with the direct costs. Direct costs for a Maryland resident, tuition and fees comes in at $12,110. Then for the housing and food allowance, that comes in at $16,762. For the indirect costs, there are books and supplies that are listed at $960 here. And these are considered indirect unless your school indicates otherwise. In some cases, your school may bill you for certain supplies that are mandatory. This is something that happens a lot with the health professions. But if the items aren't included in your bill, then those are going to be considered indirect costs. Then your personal expenses. This is, miscellaneous costs that come up while you're in school. That's $970. Then the transportation expense is budgeted at $2,460, and the loan fees allowance comes in at $280. Quick note here about that loan fees allowance. One thing that a lot of people overlook with federal student loans is the fact that they have an origination fee. So sometimes a person might take out a loan for $10,000, and then they see the direct deposit comes into their account and it's only $9,800 there, or whatever the number is, and they wonder, where is the rest of that money? The difference is the origination fee, and that's something that you're responsible for paying back as well. So when you take those direct costs and indirect costs and add them all together, that gives you a total cost of attendance for the year of $33,542. Now, You want to take this cost of attendance and compare it to the aid that was included in your offer letter. And this is a very state-specific example. So you see something there that says GA grant. This is a grant that comes from the state of Maryland and that moves through the Maryland Higher Education Commission. In this instance, the student has a GA grant of $20,700. Then there's the Pell Grant. The Pell Grant is from a federal program, and that's $7,395. The offer letter also included subsidized loans of $3,500, and that is the max that an undergraduate student can borrow in their first year if they're a dependent student. And then there's also an offer for unsubsidized loans at $1,947. There's a Parent Plus loan line item there, but right now that's set at zero. So if we take a look at the direct cost, that's the tuition and fees, the housing and food allowance, that comes out to $28,872. Then if we take into account the grants, that gift aid that doesn't have to be repaid, it's $28,095. The difference between those two is $777. So that would be the out-of-pocket cost that you would need to cover that gap. Just keep in mind, this does not include indirect costs, but the remaining balance that you would have to the school at this point would be $777, and you would also be responsible for covering those indirect costs. So I know that this is long, but this isn't the only time that you need to do this. This is just one offer and one cost of attendance for one school. So what you would need to do is take a look at the offer letters that you have received from every school you've been accepted to, compare it to the cost of attendance, especially the direct cost, and then figure out what the gap would be. And this way you would know which school is the most affordable choice. So let's move on to the final part of this answer. Lots and lots of numbers. Thank you for bearing with me. But if you don't want to borrow any loans, you would have to pay the remaining balance, that was the $777, and cover any indirect costs. Follow the same steps again with all the other offers you received, all the other costs of attendance, and compare those remaining balances at each school to figure out which school is the most affordable one for you. All right, let's move on to question number 8. That is submitted on, all caps energy here, submitted on the priority deadline. So let's take a look at the background. That priority deadline refers to the FAFSA priority deadline. Each state has its own deadline. For this student state, the priority deadline was March 1st. They submitted their FAFSA on March 1st, and they want to know, did I make the cutoff or not? They said I should have submitted it yesterday, which would have been February 28th, but I got busy, forgot about it until 2 a.m. today, which happens to be March 1st. So let's take a look at the answer. If the priority deadline states the FAFSA is to be submitted by March 1st, then you met the deadline because you submitted it on March 1st. If, however, the priority deadline says that the FAFSA needs to be submitted prior to March 1st, then you likely missed the deadline. What you should do is contact the Office of Financial Aid to clarify that language, but it's very particular. Sometimes I remember dealing with the limited waiver, you had to complete something by a certain date, then it was before a certain date, and that can be very confusing. But the best piece of advice I can give is to really get far ahead of these deadlines. And the state priority deadline is something that's pretty steady. You should be able to bank on that. Put an alert in your phone or on your device so that next year you make sure you get that FAFSA in early and accurately. But it's okay that you submitted it on March 1st because the deadline to submit the FAFSA is way off in the future. But that priority deadline for the state is important. And it appears that in this case, if you had to submit by March 1st, then you would have met the deadline. All right, let's move on to question number 9. It says, help. This is not a good reflection of my current financial situation. All right, let's take a look at the details to find out what's going on. I have not twin dollars. You all see where my mind is. It says, I have twin daughters who will be attending college in the fall. I did their FAFSA and they didn't qualify for any aid. In 2023, our income was over $100,000. In 2024, our income was half that. Can you contact the school's financial aid office and tell them the changes in income to help get tuition lowered possibly, or can they not do that? This is a great question. Let's take a look at the answer. When it comes to the FAFSA, I'm glad that this borrower included, so many details about the income in 2023 versus the income in 2024. The FAFSA deals with information from the prior year. So 2 years prior, those are the finances that they're looking at. If 1 year prior you experienced a financial shock, loss of income, whatever it is, if your income has declined, it is important for you to reach out to the financial aid office and let them know. It's something you must do if you want to have your eligibility for financial aid reevaluated. So yes, please contact your Office of Financial Aid and request a review of your account. This review process is called a professional judgment. And for those of us who have been in aid, it's called a PJ for short. So a PJ allows the financial aid administrator to review your current situation and apply the information from that special circumstance, such as a loss of job or income, to basically reassess your eligibility. So with lower income, you should be eligible for additional aid, or at least more aid than you were eligible for in the cycle where your income was higher. So please don't reach out to FSA. Reach out to the campus financial aid office to let them know your situation changed and they can initiate that PJ. All right, on to our 10th and final question. That is it too late to apply for the FAFSA? This is a great question, and I know that it can be super confusing because there's several deadlines that are going on. There's state priority deadlines, there's separate deadlines for some scholarships and grants, and then there's the deadline for the FAFSA itself with the federal government. So let's take a look at the background so that I can answer this question. I asked my son if he had applied for it, and he said he had not. Is it too late to apply now? I'm in California, so my deadline is March 3rd, 2025. Let's go to the answer for this question. All right. So the 2025-2026 FAFSA doesn't close until June 30th of 2026. That's why I was saying that you have a long time to be able to complete the FAFSA for the federal government's purposes. You have the entire academic year to submit that FAFSA. And the last date to make corrections to a FAFSA for the 25-26 year is September 12th of 2026. Now, your state financial aid program has a priority deadline. That's different from the federal deadline, obviously. You have to have your FAFSA postmarked by March 3rd of 2025, and there's a link there to studentaid.gov that shares FAFSA deadlines for the states. Now, if you are seeking a Cal grant, then it also requires a submission of a school certified GPA by March 3rd of 2025. And for additional community college Cal grants, apply by September 2nd of 2025. And that's a postmark date. We've helped some people in California, but I think this is the most specific advice we've given. So it's really cool to see that people from California are, becoming a part of our community. So thanks for that question, and good luck with the FAFSA for the upcoming year. All right, at this time, I'm going to check the comments to see if we have any additional questions that have come in. I don't see any on Facebook or YouTube, so I'm going to go ahead and move toward closing this episode out by sharing a resource specifically for Marylanders, and that is the state's Student Loan Ombudsman. The Student Loan Ombudsman helps borrowers who are experiencing problems with their servicers. Those problems may include failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidations or modifications errors, and or inappropriate collection activity or tactics. So if you're experiencing any of those issues and you have reached out to the servicer, to try and work through and get to a resolution, and you just find that you're not getting anywhere, that's when it's probably time for you to engage a third party to assist with your self-advocacy. And the Maryland Student Loan Ombudsman is a great resource for that. So please do reach out to the Student Loan Ombudsman's office. You may want to submit a complaint to see if you can get things moving toward resolution a bit faster. All right. Well, That does it for this edition. This is the March 12th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. I want to thank you so much for joining me today. It is a wild time and there are lots of questions. We will do our very best to just keep up with current events and figure out how that trickles down to the borrower level or the student level and help wherever we can. If you have a question, please do reach out to us. You can fill out our contact form. It is mccfw.org/contact. I will tell you that in times of high volume, it may take you a bit longer to get an answer because we're a relatively small crew. And with the pace of change that we're seeing right now, there are lots of questions about things at the federal level, the state level, and even the campus level. But like I said, if you have a question, please do submit it at our website, mccfw.org/contact. And I'm going to check one more time to see if we have any comments or questions. I don't see any on Facebook, and I don't see any that have popped in on YouTube. So I'm going to go ahead and wrap up this episode. Again, this is the March 12, 2025 edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I thank you so much for joining us today. You can stay connected with us on socials. We are at the MCCFW on Instagram, X, and Facebook. And we really appreciate your engagement. Please do like, follow, subscribe, all of that so that we can stay in touch. And until our next edition, which is scheduled for March 26th of 2025, as always, be well.